We are continuing our discussion. Last week, we started discussing about the economic analysis of financial structure. And at the point I was stopping the discussion, in fact, I highlighted the basic facts, 8 basic facts that explains about financial structures around the world. And then I was talking about transaction cost, and within transaction cost, how the transaction cost was explained in terms of economies of scale and average cost. And then we came to the asymmetric information within that adverse selection, hazard, theory, and try to kind of look at the lemons problem, where the entire market often thinks that the products available are inferior quality. So the pricing would be often not for the quality, but on the basis of assumption that the poor status goods are available. This is the used car market. So I was explaining that. Then this adverse selection problem that I was explaining explains facts 2 and partially explains fact 1. And there was a question by one of the students to see how the fact be explained. So for this particular point, I will explain how in line with the facts that we were looking at. But then from this point onwards, you can revisit the facts, 8 facts after each point that we are discussing, and relate it and review yourself. So that would make much more applicable in terms of how you are trying to understand the facts that we were discussing. So this adverse selection, how that influences the financial structures. So looking at the facts 2 and fact 1. Okay. So to see that marketable debt and equity securities is not the primary way in which businesses finance resources externally. That is now known to all of you. We have explained with empirical circumstances of most industrial nations in the world, how they were sourcing funds from externally to expand their businesses or engage in economic activity. So what you are basically learned is not the direct finance is the most important, but indirect finance is the most important. So indirect finance is what? Financial intermediary driven. So to say that, so-called adverse selection being addressed much more efficiently by indirect finance, that is intermediaries, than you yourself try to kind of screen out who is coming with the moral hazard, who is coming with agency problem, right? Or who is coming with the adverse selection in the first place itself. If you try to kind of do that function by yourself, you will have much more difficulty and inefficiency. The financial intermediation or the indirect finance addresses the adverse selection problem, right? So what you are basically trying to understand here is that market is solving some of these concerns that you might encounter on your own if you try to raise finances by leveraging your strengths, right? So to say that these basic facts, that's how you interpret. You look at it, what's the problem is, and then you try to link that with the basic facts of financial structures and try to explain it to the market. So it's better explained in terms of financial intermediaries taking care of the problems that you will encounter, and that itself shows the financial intermediation play a very significant role in financial markets, and partially explains fact 1. Fact one is stocks are not the most important source of external financing for businesses. Okay, so stocks is what? Direct finance. Okay, so you are raising finances by issuances of stocks or expanding the ownership stake. That also you are sourcing, you have to put effort, you have to try to figure it out who are the partners for your business. So you have to do the screening. So to some extent, it's challenging. So that's why even if you find businesses, they go to the market. Actually, the businesses who go to the market for the first time, for instance, the family businesses they started, but they are going to the market now. So when they go to the market, what they do there is they do not necessarily divest the ownership stake. They at least try to keep 51% still with them. Only they divest a smaller portion, not up to 49%. Sometimes it may be for 20% or 10%, right? Because they have still kind of a concern whether they are inviting right owners, stock owners to the business. So this is a concern. So to say that the facts 2 is very much explained because indirect finance. Fact 1 partially explained, and is also to say that you source finances if you have those concerns very significantly in your market, in your financial sphere. So what basically says is the intermediary finances would be able to solve your considerations rather than you yourself try to kind of source finances and try to address funding requirements of your business enterprise. So I hope this explains now how you link the concern with the facts explained in this particular discussion, and then you can interpret and move on. Right? Any question with respect to that explanation before I move on? Even if you have a concern, you can write it down because this was raised by one of your colleagues in last discussion. So I thought it's better that we explain before we move on to the discussion in detail in today's discussion. Right. So if you have any concern, any question, you can again explain. You can actually request to explain. If not, you can raise the concern by unmuting, so I will be able to clarify that point. So we were talking about transaction cost, the asymmetry, and we talked about the lemon problems, right? So to solve this adverse selection problem, you know what the adverse selection is, right? So to say that you have certain, because you see, when you see adverse selection, you are worried about to some extent others are making use of your expertise. They're not necessarily contributing to the full capacity that they could contribute. For instance, the moral hazard, right? Because they have their vested interest, they're probably looking at it rather than fully engaging in the business activity. Agency problem, all that is there. So to avoid this consideration, there are tools. One is private production and sale of information, right? This is what sometimes specialization is all about. There are certain segments in the market, in the industry or the financial structures, they have the information. So to say that this information do not publicly share, they keep it for parties who are ready to purchase from them. Even when you are studying, some of the information that you require, some are available publicly, some you have to source it by purchasing, right? So these agencies, even some models that you want to apply in your, let's say, research work and things like that, you can actually purchase, right? So these can be, or even the information, rightly structured time series information, then households information, there are certain publicly available information. You can access central bank, you can access Department of Census and Statistics, you can access research done by universities. That's there. But at the same time, there are agencies, for instance, Nielsen's, they do marketing related. They don't publicly provide some of this information. They provide them at a fee. So the adverse selection to be avoided, you want the information. So to get this information, some are publicly available, some are not publicly available. So you have some arrangements where you produce this information to avoid so-called free riders. Free riders are there. They don't work, they don't put their efforts fully, but they rely on, even in exams, probably you find similar circumstances. Your friends even, they would not put their efforts, but they rely on you. And of course, because of the peer engagements, we probably share that information. But it's ideal that they also put an effort. They also help you out from another perspective. For instance, you cover first 5 chapters, he covers the 6 to 10 chapter. So the expertise on 6 to 10 is coming from him, 1 to 5 from you. So it's a more or less a cohesive arrangement. But if he doesn't have that same approach, so you probably arrange circumstances. You help 1 to 5 chapters by selling your information, right? Or teaching or doing some extra coaching in terms of a kind of a payment structure. So you have to work out this. So this is common in financial markets, not like the example that I took to explain here. Yeah, even if you see on online sites and things like that, even for research, thesis writing, right? Running models, there are publicly advertised sources where you can get their services for fee. Right. So to solve this adverse selection problem, yes, one is private production and sale of information. Then another form of solving this adverse selection problem is so-called regulation. Right. So who puts these regulations? Government, regulatory agencies. Central bank asks banks to reveal. If you are a quoted public company, quoted in the stock exchange, Securities and Exchange Commission requires you to comply with certain regulations. So to say that, you have to publish your unaudited accounts, audited accounts with certain time duration. You have to make announcements. You have to make changes to your management being announced in advance, right? Insider trading possibilities being minimized, right? And central banks then take care of entire economy and publish the annual reports that gives the kind of entirety of economy's picture, right? That's the information, and it's regulatory requirement in terms of the legislation in this country. Central bank has to publish it within the first 4 months of a financial year of the health, the status of the economy of the previous year. So to say that there are certain elements of information, central bank also rely on third-party agencies, the growth that comes from census and statistic department. So if they don't work on time and deliver that, central bank would be in a difficulty. But such circumstances, central bank try to solve by provisionally estimating GDP at such point, but generally DCS comply with that. So this type of information through regulation being provided to the market, at least the minimum required information available across all the market participants, all the stakeholders. So this is the way through which the central banks and regulatory agencies or the governments try to make sure they are trying to address these adverse selection possibilities. Okay, so that then again, this regulation and increased information explains the fact 5. You can go back to fact 5 and try to see what is that fact and try to interpret in terms of the regulation to increase available information. So to reduce the asymmetry to a great extent, right? So then the financial intermediation itself, right? So we talked about direct and indirect finance. So financial intermediation is indirect finance. So you can see that explains the facts 3, 4, and 6. You can go back to facts 3, fact 4, and 6 and try to relate how the financial intermediaries solve those concerns, right? So to say very clearly, you can look at the facts again, okay? 3, 4, and 6. Indirect finance is financial intermediation. Financial intermediation itself is fact 4. So then fact 6 is who has access to direct finance, mostly the large established corporations. They have the expertise, right? They have the resources, they have the know-how. The small timers, first timers have difficulties. So you can come back and review these facts in line with the explanations there and try to interpret them to see how practical, how these things being solved by the financial markets through these arrangements. Then the collateral and net worth. What is collateral? You go to borrow finances. The banks would ask you, or the financial intermediary would ask you to keep part of your resources, assets. So you want to borrow, they might ask you to pledge your motor vehicle. You have certain motor vehicle loans, housing mortgage loans. So they are the collateral itself is the loan consideration, right? So you have that collateral. Even if you buy, if you go for a loan, you might ask collateral in the form of some guarantors, right? So this is to make sure that you are obliged to honor. Otherwise, you would become naturally you will become a moral hazard oriented, and you probably do not take with care to kind of honor your obligations back to the financial intermediary. So even net worth is similar. If you are a high net worth or highly publicly accepted, your credibility matters. So you yourself is there means there's a big possibility that he himself will push because he is reputed and he is resourceful. Net worth is resourcefulness, right? So your net worth itself guarantees that you can get the finances from the financial intermediary, right? So the collateral and net worth itself is established in financial markets to solve these problems. So you go back to fact 7 and see what it is, and try to see whether collateral and net worth explains, right? And it solves the concern with respect to the fact 7 that we have highlighted. So that's how you try to interpret here, right? So similarly, so the other aspect is the moral hazard. No moral hazard already, that also impact the choice of financial or the enterprises, what type of financial contract that they prefer between debt and equity. Equity is ownership driven, debt is intermediary driven. Okay, so you compete yourself, compete with your thinking that what is to get selected here, which position I will opt for, whether debt or equity, right? So the concerns here is principal agent problem, right? So when you have principals, the owners, if you are actually bread and buttered in a particular industry and you run the same industry, you are certainly knowledgeable. But often you find stock owners or the shareholders or the owners of businesses, they actually build their bases, if not resources, net worth, through many other forms, but not necessarily by kind of enhancing their know-how in the same industry. they expand to other industries on the basis of their resources and let agents are the managers, they learn and they experience, they have expertise in that field to take over. For instance, you see health and recreation kind of activities. Look at it. So look at health hospitals, private hospitals, whatever. Owners, maybe one or two, yes, from the field itself. The majority would not at all coming from that field. They invest. But who run the business? Mainly the administrators looking at the overall structure, but effectively the professionals in health field, right? So to say that the agents have their requirements in terms of maximizing the benefits, principals have their requirements in terms of maximizing their investments return. So to say that this principal agent problem always competing with each other. Sometimes the concerns for sustainability, concerns for so-called social responsibility considerations, right? And concerns in terms of the circumstances in which the operations require to prioritize certain type of activities, like in pandemic circumstances that we are now experiencing, whether you pay the workers or you cut their salaries. So these are all considerations, right? So the principal agent problem is that agents are trying to maximize their benefits, whereas principals would not have the information required to arrive at so-called informed decisions with respect to the operations of the agents, right? So they require to hire third parties, and third parties also would then sometimes act not necessarily in line with the principal's priorities. So these are the concerns. So which debt contract or equity contract you prefer? So because you wanted to maximize your own benefits, you probably look at it, no, I don't want to expand the business by bringing in new owners, new stakeholders. So I will go for a debt contract rather than equity contract. Principals might think like that, right? The agents might think, no, we wanted to see, we had to promote equity contracts, the more ownership. Why not expand the ownership stake of owners or call for new? So to dilute the ownership structure. So these are the competing interests. So ultimately, what matters, how being selected, depends on informed, information, evidence-based decisions that you make, right? So then the other aspect is separation of ownership and control of the firm. Okay, so owners often, as I was explaining, come with backgrounds not necessarily match with the business. Sometimes yes, sometimes no, right? But often we see owners, they will come with a background, they have resources, but unfortunately they don't have the know-how, so they bring in expertise. Okay, so expertise being used to manage through hiring agents. But ultimately what happened is the managers or the agents pursue personal benefits and power, right? So they wanted to see, although the businesses could have opportunities to expand fast and become very resourceful to the principals, but they might make sure that they also keep a say in the entirety of the arrangements by maximizing their own benefits and power. So this is often seen across different conglomerates, corporates, and after a point you find the changes in senior management happens due to this type of possibilities, right? So this also a reason at times the so-called the self-benefit, moral hazard drive which type of financial contracts preferred by agencies. So see that this type of possibilities and try to kind of recognize the tools available in financial structures to address this principal agent problem, right? So the agents often try to maximize their power and benefit at the expense of principals. Principals, while they usually have a background, but often you see in a highly expanded, globalized financial structures, it's very challenging principals to have the expertise fully required to run the complex operations of today's business enterprises. So how they solve these problems, so-called principal agent problems, right? So we call PA problems. PA problems is one way of looking at it from a monitoring, okay, monitoring perspective. So this is costly. You have to see monitoring, even if you employ a CCTV camera structure, right? Independent verifications through, let's say, law enforcement agencies, or for that matter, you yourself hire private securities and to kind of employ to make sure that agents are not misusing, if not overly using their authority in running the enterprises. It's costly. Okay, so to see that to great extent, still this monitoring exercise is important, and try to explain the fact one. Fact one is you often see it is not the equity the most important source of external finance. So to say that the principals might think, yes, we will bring in intermediary based finances to the organization. So the intermediaries also will keep an eye. And actually, if you look at the way in which Japan and Germany operates, the financial intermediaries, they pump a very significant amount of finances to the businesses, and at the same time, they keep businesses operations very closely monitored, because their finances at work, their finances at risk, right? So to make sure that their finances actually and in line with the contractual obligations being employed, those financial intermediaries have a very strong system of monitoring how those finances being employed. So to say that the principals also happy, that reduces their headache in terms of their run with agents. Right? So that explains fact one. So you can revisit the fact one, you can try to identify it on that basis. Then you see the regulation to increase information. We already explained this. So the minimum standards established by governments, right? Make sure that the standards being adhered, because these finances employed to the organization requires to be publicly or detailedly disclosed to the markets, right? So the regulation would specify not only the health of the organization, but also the people who manage the organization, changes to the leadership, changes to the management. This need to be announced. You may see, if you look at the financial intermediaries, banks, if a chairman is opting out in advance, at least 6 months ahead, you have to make that announcement to the market. And to most effective, smooth transmission of arrangement, you find these announcements are made 1 year ahead. You can see these changes. The CEOs retiring, they identify who is the one who is taking over. That's been announced. So these are the arrangements in place to great extent to facilitate these arrangements in the financial markets. Then that explains fact 5. We already discussed that. You can revisit that and see what's the fact 5 is. how these government regulations try to explain this principal agent problem. Then you see financial intermediation itself, indirect finance, that itself solve the principal agent problem and help to address the fact 3. So the fact 3 is there. Fact 3 you can review and you can see the element there and you see that the fact 3 being explained on the basis of financial intermediation itself. Then the debt contract, not equity contract, debt contract, that is fact 1. And that also explains the so-called principal agent problem. So these verifications actually help you in line with identifying underlying considerations in terms of these facts that we are trying to address through financial structures, and how that financial structure and how these tools that we are now going through here would help to solve the PA problem. So likewise, you can revisit one after the other and try to see. So I'm just trying to see if any queries being raised by any one of you for further clarification, or if not, you can raise it if you want any further explanation with respect to what I was explaining. Right. So the other element, so-called moral hazard, which influences financial structures in debt markets, right? So to say that borrowers have incentive to take on projects that are riskier than lenders would like. So what you are basically seeing here is, when you find a project which is riskier, you prefer rather than your own resources being employed, that means equity or ownership resources being employed, you opt to go for a financial intermediary driven, debt driven contracts, right? So to say that the project is risky, so he's little mindful, why should I put my own resources? Why not I get a financial intermediary to invest in the form of a debt? So to say that the debt market, if not financial intermediary finances, are exposed to a little more riskier avenue than what the project actually explaining, if not revealing to the financier. So because of this reason, this is a moral hazard. You don't actually, it's like a health policy, that life policy you are buying. You are not explaining your circumstances when you are contracting a life policy or a health policy. So to define the premiums, right? So the insurer would actually give you a policy, but that would not necessarily reflect your actual circumstance. You probably be much more riskier, exposed to vulnerabilities than what is explained. But there's a natural clause in the contract itself that says that the premiums and applicable benefits are in line with what you have revealed already. Anything beyond that actually happens, the insurer might actually even go to the extent not honoring the obligated insurance facility. So that's possible. So that's why even if you have your own health expert submitting required reports, they would not go by that. They would have their own registered health authorities to certify the so-called client. So similarly, you see the projects which are riskier might prefer debt contracts than equity contracts, because they are concerned that anything goes wrong, then it's not his own, but something. So that's why the financial intermediaries, when they provide such facilities, they might ask collaterals, they would look at net worths and broadly price by looking at even a good project as a lemon project. They might think everybody comes to the bank or the financial intermediary would have this objective. But the explaining is not necessarily the risk exposure. The actual risk exposure is more than what they're explaining. Okay, so to say that the financial intermediaries would price with that premium in mind. So after all, so such a morale had been established because the borrowers may think in the event that the project is risky, if that doesn't go well, probably he might kind of opt not to pay back the financial intermediary. But then the financial intermediary would take measures to make sure that his finances are secured to the maximum possible. So this itself creates additional tension and additional non-efficiency pricing structures in the market, right? So how this moral hazard in debt contracts been addressed? Already said net worth and collateral. So you bring in collateral. Fine, I'm ready to. Financial intermediary might conclude, yes, we are ready to finance your project, but you had to have the collateral. You had to have the project, you had to have the land, you had to have the cash flows, certain percentage of cash flows received by the organizations being pledged, right? You had to have your accounts being maintained with the same financial intermediary, and all the financial outflows are only up to 60% of the outstanding balance. Various ways of establishing these collaterals. So they are trying to make sure incentives are compatible with the risk taken by the financial intermediary. Then from another perspective, network. So you already have a big network. They would actually think, okay, fine, why not you put your money first? We will put 80%, you put 20%. Right? So the equity comes in then 20%. So that itself kind of, make sure that he also takes the risk rather than relying fully on financial intermediary to take the project. So it is net worth and collateral basis. So they are trying to make sure incentives are compatible with each party to the transactions. And then monitoring and enforcement. This is costly. Even if you employ, let's say, the police or anything, it is costly. Monitoring, either you employ expertise or you establish additional material, additional resources, that is costly. But those arrangements will discourage undesirable behavior, encourage desirable behavior. So agents, after obtaining debt contracts, or the principals after obtaining debt contracts, they make sure they actually employ all precautionary standards required. The machinery being employed with all precautionary standards required. Right? So to make sure, even if you have a refrigerator, you have a certain electric equipments used in your private residencies. So to say that, so the power transmission being managed in the form of controlling at times of higher voltage. The systems itself stops. So these are the kind of controls, enforcements they have brought in. The collateral valuables. You see, you've been asked to put collateral, but collateral could change in prices. You see, you have pledged a land, but the land prices may deplete if that land is originally in a, let's say, a location which is good for living, but unfortunately the unexpected developments in the form of floods, unexpected development in the form of new projects being established, that's become hazardous for living, right? So then the collateral value decreases. So the financial intermediary may ask you to bring in new assets to top up the collateral value. So to keep collateral valuable throughout the life of the financial contract, debt contract in this case. This happening all around the world. Then you see information. You have to give information on a continuous basis, right? They are not only monitoring your financial statements, but also your future contracts, your arrangements in terms of future supply contracts. That's why you see purchasing manager indexes, PMIs, being now looked at. PMIs would not necessarily say what's your precise exports, what's your precise production. No, but production requires, let's say, 3 months, 4 months timeline to kind of, complete. But certain resources, raw materials in advance if you have a good order ahead of you. So how you have been purchased, how you have employed those raw materials, how you have asked demand for labor, additional labor. So all these are information for you to make sure that future 3 months, future 5 months, future 1 year is good in terms of their production cycles. So these informations are important, right? So then the other solution for moral hazard in debt contracts is financial intermediation itself. They look after that. That explains fact 3 and 4. So you can go back to fact 3 and 4 and try to see how the moral hazard possibilities in debt contracts being addressed by financial intermediation. Okay, so we can move on to put this so-called asymmetries and what are the tools that you have now discussed and how that explains the relevant facts that we were listed there. We have listed in our discussion. So you see these asymmetry problems in the form of adverse selection, moral hazard, and moral hazard again divided in the form of equity contract and debt contracts. So the facts also listed here underneath, right? So you can straight away see to solve the adverse selection, what are the tools? Private production and sale of information, regulation to increase information, intermediation, collateral and net worth. Collateral net worth explains fact number 7, that is nothing but collateral is equivalent in debt contracts, right? So to say that now you have summarized most of these stuff. You could have seen this before everything else, but I'm pretty sure you will not necessarily get underneath each of the considerations without having an explanation and come back and just read this. No, now you have more or less clarity in terms of what the problem is, what are the tools that you have to solve this, and how that explains the basic financial structure considerations. Those are the facts that we were discussing. So you go back and try to kind of match each one. But in this slide, you have facts also presented as note. So it's easy to compare. Try to kind of, interpret, try to kind of understand, try to kind of, relate it to more practical circumstances that you are familiar with. So that would help you try to read these with much more clarity and understand them with much more rationality. Right. So one step forward, we see this asymmetric information problem, much more severe in developing and transition economies. Transition economies are now more or less you can call emerging market economies, because formerly you probably know the former Soviet Union related CIS countries, Commonwealth of Independent States. They are moving from different structures to market economies. Former East Germany related and that bloc, right? So that's why the transitional countries were talked in the past, but now it's more or less developing, and you can call it either emerging market economies. Emerging market economies are much more market oriented, right? So they have some of these asymmetric concerns stronger than OECD, if not developed countries. OECD countries have certain standards of information dissemination. In IMF, International Monetary Fund standards also, there are two data dissemination standards. One is GDDS, General Data Dissemination Standards, GDDS, Data Dissemination Standards. And the other one is SDDS, Special Data Dissemination Standards. Sri Lanka also, up until 2014, 15, 15 or 16, if I'm not mistaken, in 16, we have moved from GDDS to SDDS, Special Data Dissemination Standards. So the requirements are a little more severe, but you have to report certain information with time-bound arrangements. So these data requirements are very important, because that disclose, it's like a health check. You have to have health checks and have to have those reports published, right? So the information is very important. The information's importance would come to know as we move to other lectures in this course. Everything matters with information, right? So to some extent, these transitional and developing economies have these asymmetry problems arising from so-called financial repression. What is this? You see, you don't have much more efficient system of property rights. So because of this, you may not have collateral efficiency. So you can say now Johanni de Silva's song. I mean, she's actually brilliant. So she's putting that in a perspective, but whether she has intellectual property rights actually being taken into the music and things like that, there are a lot of different variations. In a way, it's good because it has another element behind it. But the system, if that is really established, you would be able to use that property rights, intellectual property rights itself, to make sure that sizable resources being backed up in terms of the others using the same for their own personal benefits. Right, so these property rights has to be established through legislations and things like that. Sri Lanka is reasonably good, but still not up to the standards of a emerging or OECD country. Then the legal system. That's why, for instance, financial intermediaries have this parata arrangements, parata execution rights within the financial debt contracts, you have much more expeditious arrangements to solve if a borrower do not honor his obligations. If you go through the general legal systems to solve a property related case, you might need at least one generation's time. You probably heard of these things. So it is very difficult for lenders to then enforce so-called conventions in their covenants in their agreements. So you have to address those. And then the standards, accounting standards. Sri Lanka is much better, one of the best countries in terms of international accounting standards being looked at. But then, of course, there may be many other developing countries, they do not have the general standards being applied across the board. So it's very difficult to define the assets in terms of general standards and the way in which they have defined assets for their local standards. So you are comparing apples to oranges, not apples to apple. So that's a challenge. Right? So in multifaceted financial markets, financial intermediation in today's context, this is the challenge. Then at the same time, some of these asymmetries arise from government intervention through directed credit. Sometimes these directed credits are forced upon state-affiliated financial intermediaries. And then the channeling of these funds are also not on the basis of productive use. These are based on affiliations. They are, the parties, they are supportive of them. So it is actually at times end up as non-performing loans in the books of these financial intermediaries. So they are also, the borrowers also not necessarily covered by so-called restrictive covenants. Even if there are restrictive covenants, they probably ignore them because of their crowd. These are very bad precedents. You probably see in countries like Sri Lanka at different times, certain type of loans being extended, but those are actually not on the basis of productive use. So ultimately this falls on the shoulders of these financial intermediaries, and as a result, there's no proper information dissemination. Anyway, that asymmetry is there. Let's promote asymmetry. So the asymmetric information in these transitional and developing countries are little more pronounced, if not significant, simply because of these considerations. Then you see the financial development and economic growth. Ultimately, all these efforts are to make sure the economic efficiency being established. The financial systems in developing and transitional economies, as we were discussing, have difficulties that keep them from performing to the efficient levels one expects. Yes, even in advanced economies, at times it's performed below the potential or the efficiency required. But the circumstance or the situation is much more pronounced in developing economies. Okay. So to say that rule of law, constraints of government expropriations, then of course absence of corruption, these are things required for a system of property rights. But unfortunately, how sound some of these stuff are, it's a question for everybody. As a result, these developing economies, property rights functions poorly, right? And making such tools to financial efficiency also not effective. This I will. This is some application, some of the things that you learned in terms of yield curve dynamics in the previous lectures. You can see that right the yield curves we looking at about a year ago. This is 2020. Has come down significantly. See, the latest one is the blue line here. It reduced to a great extent. But then by beginning of, this is beginning of actually end of January, again it's almost, that means it's increased again. Reverted back to the levels that it used to. And effectively, what you are seeing here is the volatility. Okay, so to say that significant volatility is also not good, and some of the lessons that you have learned, I just wanted to signify the upward sloping, mild upward sloping, all kind of things. So try to kind of read it between lines, and you can go to this sites and again try to kind of understand these concepts. So with that note, this particular discussion, we can stop this topic, and we can move to one of the very important and significant topics, that is financial crisis. Any question before I move on to that new topic of discussion? If you do not have questions, I can go on to the next topic. At the same time, if you have anything, you can write it down and put it to the chat mode, so I will be able to read it through and explain if there's anything. But please feel free to kind of clarify if you have any considerations, because these are very interesting areas where you probably do not necessarily learn through some of the other formal programs, even the standard programs that you might be going through. So let's start then the financial crisis. And please take note of this subject, this area of discussion. You may read through some of the general financial press in 2008-9 period. Please go through Asian Wall Street Journal, The Economist, Far Eastern Economics. These are magazines very informative, so you can actually get into those and try to kind of understand the circumstances in which the markets are operating during this financial crisis period. Right. So to discuss the financial crisis, the main focus and the empirical explanations and empirical details that we discussed here is based on the 2008 global financial crisis. There are some of these elements still prevalent across the globe, but some to great extent been addressed, and the economies are very much returned to its normal growth trajectories. But certain elements have again exposed with the recent pandemic cycle. That is not necessarily financial crisis, but pandemic-driven global financial market operational restrictions, and also the countries whose fiscal or financial space being limited, they've been exposed to greater challenges. So that's something different. We will see that towards latter part of the program if we have some time. If not, you are more or less hearing those stuff in today's financial press to great extent. But the financial crisis of 2008, interestingly, had two distinct phases. Right? So the first phase, to great extent limited. This is prior to 2008 August, 12 months cycles prior to 2008 August. Why August? You will get into those details as we move on. Okay. And the pre-pace of this August 2008 circumstance is actually emanated from losses in one segment of US financial system. That is the subprime residential mortgage markets in US. In US and most of the time in advanced economies, it's not common to purchase residential properties outright. Here we often see we wanted to purchase residential properties often outright. We wanted to pay full and get the ownership. But in those markets, those are mortgage-based purchases. You are basically buying for a contractual period of 20 to 30 years. It depends. I mean, it even varies from 10 to 30, 10 to 40, depends. But the problem arises in US prior to 2008 August was concentrated on subprime. Prime is best. You see in Sri Lanka also, if you look at the weekly economic indicators, central bank publishers, yesterday also they published, they have a prime lending rate. Prime lending rate is the prime customers of financial intermediaries, what rate they get for their borrowings. That's a prime lending rate, PLR. Then the other customers, normal general customers. So subprime means below best, below prime. So to say that, not necessarily credit worthy. In the credit rating scales that you probably discussed, there are grades, investment grade, non-investment grade, within non-investment grade, number of layers, levels of credit possibilities, right? So they were looking at. And so subprime residential mortgage market had difficulties in US prior to this period. So because of this and the instructions noted in US, there were concerns. It's not that they have not taken them completely off the radar, but despite these disruptions in the subprime mortgage market, US GDP was on the rise. GDP, the economy is growing. And because of these challenges, they are looking at a possible slowdown in economy, but they expected it to be not significant, but a mild recession. Recessions are negative. In US, they call a recession if two consecutive quarters are 3-month cycles, recording negative growth, but they expect it to be very small negative, not big negative numbers. So that's the first phase, right? So interestingly, I mean, this expectation was visible in US official documentations. Okay, you can read the Budget and Economic Outlook update, September 28, 2008, right? So even they say the forecast for rest of 8 and 9, the economy is about halfway through an extended period of very slow growth. Still growth they are talking about. So this is the first thing, right? The increase also noted in unemployment rate and the pace of economic growth, they also refer are similar to conditions in previous mild recession. So to say that you don't need to worry too much, that's the kind of sounding at this point of time. In mid-September 2008, 2008, the crisis has entered to a more significant phase. In rapid successions, the big investment banks like Lehman Brothers that entered into bankruptcy, right? AIG Insurance that collapsed. They have a run on certain funds, and the US had to introduce the so-called TARP, Trouble Asset Relief Program. There are various forms of this now available in the pandemic period too. But what you are basically seeing is the health of global financial system was shaken by the collapse of big banks, big investment banks. Some, of course, actually submitted for bankruptcy, but at the same time, others had significantly their net worth cut down, and even the information what they were trying to explain or highlight were not being accepted or not being read by anybody in a sense of accuracy. So to say that, we will come to that point as we move on, right? These two phases prior to the August and subsequently had very different perspectives in the eyes of makers itself. They could not actually see the difficulty or the challenge ahead of them, and they have not necessarily seen some of these in their expectations for the periods ahead. Despite they had the very sound, efficient financial structures to kind of, read through some of these developments. We'll come to those stuff as we move on. So interestingly, the transformation from what appeared in mid-2008 to be a significant but fairly mild financial disruption into a fully fledged global financial crisis would be the focus of this section. And also we look at the government response to these financial crises helped avoid this or not. That is also we would try to understand. Okay. Then the challenges to these government interventions raised for world financial system and the economies going forward, and it's applicable to today's context too. is the more or less the broader perspective of, right, of this entire discussion that we are going to concentrate now on financial crisis. To move into that, please read this point. You can actually go to this and read, right? So I'm not going to take you through because it's disturbed sometimes with the setups here. But anyway, please read this. That's very interesting and very good, because you will get a feel what this is. You might not necessarily feel it because you are not in that period. So if you are here, you probably felt it, and the people who probably gone through in those economies would have really felt it. We had spillovers. Sri Lanka, emerging market, developing economies all had spillovers. But you had to feel it. You had to kind of, get a feel on this, try to read it, try to understand it. So that would help you at least kind of, see, at least to understand some elements of this financial crisis. But interestingly, still to some extent, you see some elements of a financial crisis at that time was visible in the form of debt levels, okay, and the trading flow of New York Stock Exchange. You can see in September 2008, everybody is worried and everybody is basically seeing the screens were running red. But interestingly, this picture that I have shown here has relevance in terms of the risk of further possible financial difficulties, be not necessarily fully discounted by financial regulators or the governments. Okay, simply because there are still, you see, the moral hazard, reckless behavior of the stakeholders all around the world, even at this point of time. So this being looked very seriously through all the financial press on a continuous basis, and you can read through also to make sure that you understand some of these stuff. But what is a financial crisis? So that's the focus that we are now trying to kind of concentrate. Please remember, financial crisis occurs when there is a particularly large disruption to information flows in financial markets. Everything that you see, the prices of assets collapses, markets go really bust, right? So to say the economies go downhill, your net worth crashes, the currencies really depreciate, weaken, the asset prices and collaterals become worthless, all fine. But a financial crisis is nothing but when there is a large disruption, particularly large disruption to information flows in financial market. There is no information flow. You have to make informed decisions. So when there is no information flow, markets become one-sided. Everybody is in the selling side. Nobody is buying. What happens then? Everybody is selling. Prices crash down. It's like everybody is supplying. Nobody is in the market to buy goods. More and more supply. Prices crash down. you can't even recoup the cost of production. As a result, what you are seeing here is the large disruption to information flows in financial markets. The financial frictions increase sharply, and financial markets stop functioning. I mean, financial frictions, fault lines. Everywhere you find the cracks. We'll get into greater details as we move on. But interestingly, that increases sharply and markets are not functioning. To function, you had to have a buyer, you had to have a seller, you had to have a demand side, you had to have a supply side. But unfortunately, at times of large disruption to information flows in financial markets, all in one side, often all in selling side, supply side, no buyers. So how to define, how to determine an equilibrium price? So the financial markets are basically at a standstill. Okay. So this spillover immediately take in the form of effects on balance sheets. Immediately asset markets effects on balance sheets. You are a super rich individual having a big billions because of your net worth. But the 90% of your net worth arise from the stock prices of equities that you own. So the markets become dysfunctional, stock prices crashing down. Your net worth, your corporation's net worth become meaningless and it decreases. And there are collapses in the form of all these financial intermediaries from multi-billion dollar corporations to insignificant volumes compared to their liabilities. So you see these asset market effects on balance sheets, firstly through the stock market. It's a very immediate across all financial markets in the world. Then unanticipated decline in the price level. So this is again the inflation. You see, when the inflation becomes negative, that means tomorrow's prices are cheaper than today's prices. Right? That's a kind of a negative inflation thing. So what happens when you see tomorrow's prices are cheaper than today's? So you would not even purchase what you require to purchase today. You will wait for tomorrow. And when you go to tomorrow, you find day after tomorrow's is cheaper. So markets are further constrained by executing suppliers and demanders agreements. And as a result, because you have liabilities, the corporations, individuals, countries, they have liabilities. That's in their books, already built liabilities. You have to service this much. That's why everybody is now talking. Sri Lanka has to pay close to $5 billion of foreign obligations every year up until 2024, 2025. Every year, 5 billion we have to pay. So we had to have inflows also to match that. So when the price level decreases, your today's transactions net worth further decreases. But your liabilities remain same. That is not going to reduce in value, but now that looks higher in real terms. Fisher equation, right? So what is the nominal interest rate? Nominal interest rate is nothing but expected inflation plus real return, right? Nominal interest rate is, let's say, 6%, expected inflation is 4%, and real return is 2%. So that's why you have 6. 4 plus 2 is 6, right? So when you see the expected inflation heading to minus, so you can see where the real returns are, to make sure that nominal interest rates matches with the Fisher equation. You can put these numbers, change this positive signs to minus, and take the sides to the other side and see what happens to the outcome. So the price levels are expected to decline. As a result, markets are further constrained to execute market clearing prices. No equilibrium. Then at the same time, your domestic currency values decline. Currency depreciate. You have already built your obligations, let's say in foreign currency. You have borrowed from foreign. So you have $1 million of obligations. So at 200 rupees per dollar, 1 million obligation means 200 million obligations. When your currency weaken, let's say to 210, it increases to 210 million rupees of obligations. Right? But unfortunately, despite these developments, your asset side is continuously shrinking in value. Your balance sheets become weaker. Your net worth becomes increasingly tilted towards negative side. Your liabilities are increasing, whereas your assets are decreasing. And on top of this, when the markets are basically frozen, there is no prices being actually visible. Everybody is one-sided. Informations are not flowing. Even the available informations are not being looked with certainty. Even the collaterals that you had in your books become meaningless. To maintain those collaterals, you have to incur additional expenses. I'll explain. I'll come to this point. Very interesting with respect to those mortgage houses, how the US subprime mortgages were behaving at this point of time. So those assets, maintaining in your books, become a costly affair. So you have to write them down to clear the balance sheets. So your business is actually the balance sheets of all these financial intermediaries and other businesses are actually heading south, declining in net worth with all these developments. And as a result, your ability to immediately recover also get postponed, delayed. So this is the circumstance in which the financial markets were going through by September 28, 2008, 2008. Right? So what causes these financial crises? So the deterioration in financial institutions' balance sheet. Already you have seen it's deteriorating. Then your ability to lend also declines because of this. Because you have a resource base to define your lending portfolio. When your balance sheets shrink, balance sheets become small, the resources available with you to lend also decline. Then the banking crisis. This is purely information problem. Loss of information production and this, as a result, disintermediation. People not now believing financial intermediation at points of the crisis. At this type of circumstances, they try to move out from financial intermediation because they are not sure whether their finances are secure. They try to kind of withdraw. And even with all these developments now we are seeing, people become little more precautionary. They try to keep more than what they required in liquid form because they don't know all of a sudden lockdowns. All of a sudden they require additional expenses. They would not be able to withdraw from usual channels. All these are possibilities. This creates disintermediation. And then the information, usual information, prices reflective and the resources available in terms of effectively monitoring, screening, and providing expertise all become vulnerable and uncertain because information you have is not certain. And also the information available might be highly volatile, changes very frequently. And this is again increases the uncertainty. You don't have certainty, you are uncertain. So every time you look at the collateral, because of this possibility, you mark up, you reduce the value of the collateral for these uncertainties. If you have 100, you effectively looking at 60 or 70 because you are uncertain whether this value would prevail or whether this value further decrease. You don't look at it increase because everything is uncertain. So as a result, further reduction in lending. You don't pump resources to the economy. The absolute volume of lending further decreases. You will see with absolute numbers how the markets were responding to some of these stuff. Then increases in interest rates. You are not ready to lend because uncertainty and default probabilities are greater. So you are worried about adverse selection, whether you are selecting a right party for the transaction. And the behavior of, again, economic agents to fund through external funds, debt contracts, than equity contracts, that increases in such circumstances, and also the possibilities of adverse selection and moral hazard. That itself now requires additional premium. So increase in interest rates is very common. So that further constraint from another perspective how quickly you can come out from the crisis and reduces the lending volumes of the financial intermediaries. They become little more risk averse because they are worried about higher adverse selection possibilities, higher moral hazard probabilities at times of financial distress. And also the organization itself would have stipulated certain restrictions in terms of volumes to be lent, parties to be lent, and also the collaterals to be valued. They become very conservative. And this is, let's say, financial intermediaries problems. But from a government perspective, if their fiscal position is already in trouble And most of the developing countries and also developed economies, some had these problems, especially southern European countries in 2009 period. The fears of default on government debt, even Greece, why they default? Because of these developments. Italy, they did not default, but there were a lot of fears. Right? So the investors would pull out their money from these economies because of these problems. These are further magnifying the problems of financial crisis. It's sitting on the volcano, about to erupt. Right? So the circumstances in which that you are seeing these difficulties magnifies the problem at hand, the crisis, and because of these factors, the crisis get magnified. Okay, so these the circumstances these countries were experiencing, and we'll come to these dynamics now. Before that, any questions? Any questions to clarify?
So can you explain about the interest rates during a financial crisis, that part?
Sure. The notes, I think it's already shared. These the presentation slides being shared by the IBSL. So it's very strange for me to kind of see some of you have not received. It's maybe one or two, but generally it's available. It's available across the IBSL. They share with everybody. So that's there.
Okay, so I'll go
so
through.
the explanations, of course, the explanation I'm explaining, of course, I'm not reading through the slides. That's not my style. I look at the heading itself and often explain on the basis of subject at hand. So I don't see a problem with respect to the presentation slides. You can read through some of these publicly available, or the textbook that we are referring, all that is available in those materials already shared. So you can go through the details. If not, you can follow up with IBSL, and I'll tell IBSL also to share this information. And with respect to the question of interest rate, right? So to say that interest rates generally, the demand and supply sides outcome, equilibrium. We have learned all these in great details in our last two discussions. So what you are basically seeing is when market supply side is increasingly restricted by reduction or the decline in balance sheets, because financial intermediaries' balance sheets are shrinking at times of financial crisis. So naturally, the supply side moves to the left. So at each point of demand, the intersection would be now at a higher interest rate point. This being said, you see at points of financial crisis, we discussed a little while ago the financial structures, the moral hazard, probabilities of debt contracts. Even the projects which wanted to expand, wanted external finances, would not bring in equity funds. They will bring, more or less, they favor debt contracts. So that means the demand for funds from the markets would go further up. That means demand curve would shift to the right. So draw this supply curve shift to the left, demand curve shift to the right. The interest rate, resulting interest rate, would be much higher than what it was. That's very straightforward explanation. But here, underneath those developments, the suppliers, financial intermediaries, are also worried about adverse selection because information is now disrupted. Even the available information's accuracy, certainty, being questioned. And the ability to get that verified also become challenging because asset prices also crashing. At points of financial stress, financial difficulties, even the available information would not necessarily be factored on its face value. It factored with a discount. That means even the collaterals that we were discussing would not be taken on its value, would be discounted to say low value being factored in debt contracts. All in all, this spills over to charge a higher risk premium because the risk elements are now magnified. The probability that the funds that you lend to these organizations would become a little more uncertain in terms of how they might be servicing because their business opportunities are also shrank. I was explaining when the deflation sets in, right? Negative inflation, even you probably delay your consumption. So that reduces the probability they come out from the problem. So the spreads, we will see that in empirical evidence, how the spreads of different borrowings have expanded significantly from where they were. And in real terms, when inflation also becomes negative, sometimes the nominal interest rates would be same. But what you are basically looking at here is the real terms, the interest rates are really increasing. And effectively, even nominal interest rates have gone up during this period, especially across developing economies and also in some advanced economies based on their other macroeconomic variables. So I believe this explains your concern with respect to interest rates.
Yes, sir. Thank you.
Right. Any other questions? Right. So you see these developments across these markets, and these factors magnify and to some extent cause the financial crisis from a pre-August point of view to September 2008 perspective that we were just highlighting. So the financial crisis have magnified to the extent the world financial markets were actually at a standstill. And we will now get into dynamics, and particularly in terms of advanced economies. And then we can discuss this in terms of some of the developing economies perspective and the dynamics of this financial crisis has different stages. The initiation of financial crisis in advanced economies were to some extent pinpointed to financial innovation and financial liberalization. it's good, but to some extent, there were mismanagement. We will explain those in CEOs, yes, how the collateralized debt obligations were developed by these financial markets, financial innovation, right? Financial liberalization, but effectively that further enhance the riskiness of some of those financial assets, and those riskiness being ignored by these markets simply because markets were on a continuous one-sided boom, that is increasing asset prices continuously for about 10-15 years. So they expected that to last for eternity. They continuously expected these prices to go up. But then with the reversal, everything started collapsing. So we'll get to that and explain when we look at the CDOs. But at the first stage of this financial crisis in advanced economies, we have seen financial liberalization and innovation being mismanaged. Then you see asset prices, they have boom and bust cycle. Boom is continuous increase in asset prices. Bust is collapse of asset prices. Please go to YouTube and play the video. The Keynes versus Hayek, Hayek, Hayek. Keynes, right? Keynesian economics and then Austrian economics. There's a nice video, booms and bust cycles. That is a song, and you can actually see for yourself how we looked at the asset prices being viewed as continuously rising from one cycle, and when it started decreasing, what happens to the markets and the economies and all. So in any circumstance, prices of different financial assets and other real assets has a price direction. It increases with countries, economies grow and all that. But those increases has to be backed by real economic fundamentals. If it is on the basis of speculation or creation of credit, right, credit driven, there is a possibility the asset prices would collapse. And the circumstances in which the financial crisis of 2008-9 been viewed had a very dynamic empirical example by looking at late 90s and early 2000s developments in Japan. The asset prices in Japan were on a continuous rise since mid-1980s. Real estate prices, small apartment prices in Tokyo were skyrocketing. Every day, the prices of these assets are expanding. And there were arguments to say that real estate prices in Tokyo is worth much bigger than the entire California state's real estate value. California is very big. You go to the map and see, right? So to say that the asset prices were on a one direction in Japan has come to a point towards latter part of actually in the early part of 2000s. The Japanese economy started stagnating. At one point, there is no further boom in prices, but prices started collapsing, and the people who have invested, even pensioners, all their retirement income being invested in real estate have lost all their investments. They took decisions of suicide in those circumstances, in those economies, because they lost everything. Because they expected one-sided boom, but it reversed and the market started collapsing. The stock prices started collapsing. Japanese economy started stagnating. They were on a continuous increase, and the demand were on a continuous rise, but unfortunately at a point started reversing, and as a result the economy has not moved for a considerable period. They took more than a decade to see that the economy is getting back to the levels that they experienced in early 2000s. So all that period was stagnating. That does not mean Japan's wealth has come down, but the boom, the speed in which this were growing were kind of, basically forced, if not started declining. So similar circumstances is visible during the financial crisis of 8-9. Asset prices were on a continuous boom as a result of demand coming from middle income classes of US, expanding middle income classes, and demand from all around the world, rest of the world, expanding Asia. Japan is one source, China is another source, East Asian economies another source. Everybody is buying assets, US assets. US assets are reserve assets. We buy US treasuries. So the demand created by real estate purchases, also the higher income of oil and other commodity prices, all were channeled to US. US prices were rising. So this one directional rise, all of a sudden, and US policy interest rates, that also a reason. They argue they were kept at a low level. That's the argument. We will come to that point and explain, because there were arguments for and against, right? Rather than tightening, monetary policy interest rates are kept at a much more comfortable level, and that also contributed to increase the asset prices in US. And more than that, it appears that asset prices in US were continuously rising due to loose regulatory, if not financial intermediaries, lending practices. Okay, so then you see all of a sudden US policymakers recognized some of these elements and started looking at some tightening of interest rates. They started reversing the loosening cycle, started adjusting the interest rates upward, and this being felt significantly across some of the subprime mortgage lending market. And then the uncertainty, which actually created uncertainty of the direction in which asset prices were moving, and contributed to have a different perspective in the direction of US asset prices were behaving, and the market segment subprime started feeling the shock of gradually collapsing demand and defaulting, increase in default numbers, and people were not honoring their debt obligations. They were handing over the collateral, that is the house's mortgage, and as a result, house sales were coming down, and then the piling up of collateral started reducing the collateral values. So these were the initial phases of the financial crisis they have seen at that point of time. So we can come to stage 2 and stage 3 in our next discussion. This is a good point for me to stop but please read through some of these elements and try to see some of these aspects in your reading and reading materials. So that would give you a little more details when we start the discussion next week. Any questions before I wind up the discussion today? If you don't have questions, we'll stop at this point and we'll meet in our discussion next week. And I'm just highlighting you. Please read through some of these discussion points and stay safe. Thank you.